What they didn't tell you about the night before Lehman Brothers fell. On the night of September 14, 2008, just hours before Lehman Brothers would file the largest bankruptcy in U.S. history, a private call took place between the heads of America's biggest banks and Federal Reserve officials. The conversation wasn't recorded. The minutes were never released. But according to insiders, there was a moment of eerie silence. After J.P. Morgan's Jamie Dimon allegedly asked the question no one wanted to say out loud. If Lehman goes, who's next? No one answered, because deep down, they all knew. It could be any one of them. In that moment, it became clear that the system they had helped build, the towering skyscraper of leverage, synthetic credit, and opaque financial instruments, was nothing more than a house of cards. And the wind was already blowing. What followed wasn't just a market panic. It was the most dangerous moment in modern financial history. A moment when trust disappeared from the system entirely. And when trust vanishes, money dies. Yet even now, 16 years later, we cling to a sanitized story of bad mortgages, reckless bankers, and a housing bubble gone bust. It's a comforting tale, but it hides a deeper truth. Because the real story of 2008 is a story of design, of deliberate complexity, of unchecked ambition, and of how close we came to watching the entire global economy stop. On September 15, 2008, at 1:45 a.m., a group of exhausted regulators sat in a conference room at the Federal Reserve Bank of New York, staring at a decision that would reshape the global economy. Treasury Secretary Hank Paulson had just informed Lehman Brothers executives that there would be no government rescue. The 158-year-old investment bank, with $613 billion in debt and tentacles reaching into every corner of the financial world, would be allowed to collapse. What happened next wasn't just the largest bankruptcy in American history. It was the moment when the interconnected nature of modern finance revealed itself in all its terrifying complexity. Within hours, credit markets froze worldwide. A major money market fund broke the buck for the first time since 1994. Stock markets from Tokyo to London went into freefall. The global financial system, built on a foundation of trust and interconnectedness, began to crumble. But here's what most people don't understand about that moment. The crisis that followed wasn't really about Lehman Brothers. It wasn't even primarily about housing. It was about how the global financial system had evolved into something fundamentally different from what existed just a generation earlier. A system so complex and interconnected that even its creators couldn't fully comprehend what they had built. 16 years later, we still tell ourselves a comfortable lie about what happened in 2008. We say it was about greedy bankers making bad loans to people who couldn't afford houses. We say some regulations were passed, some banks were bailed out, and we moved on. Crisis averted, lessons learned. This narrative isn't wrong, but it's dangerously incomplete. The real story of 2008 runs much deeper, and its lessons remain urgently relevant today. Because the truth is, we fixed some of the symptoms, but never addressed the underlying disease that made the crisis possible in the first place. To understand what really happened, we must journey back to 2001, when the Federal Reserve, faced with a bursting dot-com bubble and the September 11th attacks, began what would become one of the most consequential monetary experiments in modern history. Under Alan Greenspan's leadership, the Fed slashed interest rates to just 1.1% by 2003, levels not seen since the Eisenhower administration. This wasn't temporary crisis management. It was the beginning of a global hunt for yield that would prove devastating. When safe investments in U.S. Treasury bonds yielded almost nothing, enormous pools of capital, sovereign wealth funds, pension systems, insurance companies began searching desperately for higher returns. This money didn't just make it cheaper to buy houses in America, it triggered a cascade of risk-taking that would reshape the global economy. The numbers tell a stark story. Between 2002 and 2006, mortgage debt as a percentage of U.S. GDP exploded from 61% to 97%. But this wasn't just American families borrowing more. It was the financial equivalent of adding rocket fuel to an already combustible mixture. Easy money created what economists politely call moral hazard. The tendency to take greater risks when you believe someone else will bear the consequences. Greenspan, a devoted disciple of Ayn Rand's free market philosophy, believed that markets would self-regulate. This laissez-faire approach, combined with historically low interest rates, created a perfect storm. Financial institutions, flush with cheap money, began taking risks that would have been unthinkable just a decade earlier. Meanwhile, deregulation compounded the problem. The 1999 repeal of the Glass-Steagall Act, the Depression-era law that had separated commercial banking from investment banking, allowed Wall Street firms to become enormous financial supermarkets. Even more critically, the Commodity Futures Modernization Act of 2000 virtually eliminated oversight of over-the-counter derivatives like credit default swaps. By 2008, the global derivatives market had ballooned to an estimated $530 trillion, roughly 10 times the size of the entire global economy. This wasn't just financial innovation, it was financial mutation on a scale that defied comprehension. We had created a shadow banking system that operated outside traditional oversight, spreading risk in ways that no one fully understood. Parallel to this monetary experiment, something equally profound was happening to the basic business model of banking. For most of the 20th century, banks operated under what we might call the George Bailey model. They took deposits from local savers and made loans to local borrowers, keeping those loans on their books until they were paid off. This model had a built-in safety mechanism. If you made a bad loan, you absorbed the loss. It focused the mind wonderfully. But by the 2000s, banks had discovered they could package loans into securities and sell them to investors around the world. This originate-to-distribute model seemed brilliant. It allowed banks to make more loans by freeing up capital, and it spread risk across the global financial system. What could go wrong? Everything, as it turned out. The moment you separate the person making the loan from the person bearing the risk of that loan, you create a moral hazard problem. Suddenly, the incentive shifts from making good loans to making as many loans as possible. Quality becomes someone else's problem. This is how we got ninja loans. No income, no job, no assets. And why those loans were not only made, but actively marketed. By 2006, subprime loans accounted for 23.5% of mortgage originations, up from just 8.2% in 2003. Everyone in the chain, from loan officers to Wall Street traders, was responding to perverse incentives that rewarded volume over quality. The loan officers got their commissions, the banks got their fees, and the risk was passed along to whoever was foolish enough to buy the securities. But here's the truly perverse part. The buyers weren't foolish. They were among the most sophisticated financial institutions in the world, armed with complex mathematical models and staffed by some of the brightest minds in finance. The credit rating agencies, Moody's, Standard & Poor's, Fitch, were supposed to be the guardians of financial truth. Their job was to assess risk and tell investors what they were really buying. Instead, they became active participants in the very machine that was obscuring risk. The problem was structural and inevitable. The agencies weren't paid by investors who wanted honest assessments. They were paid by the issuers who wanted favorable ratings. It was like having restaurant critics paid by the restaurants they were reviewing. Under this issuer pays model, the rating agencies had every incentive to please their best customers, the big investment banks, by awarding rosy ratings. By 2006, Moody's was earning more revenue from structured finance deals than from all its traditional rating activities combined. But the agencies faced an even deeper challenge. They were trying to rate securities that were fundamentally new and impossibly complex. A traditional corporate bond involved rating a single company's ability to repay its debt. These new securities were like rating a company that owned pieces of 1,000 other companies, each of which owned pieces of 1,000 other companies. The agencies handled this complexity by building mathematical models that made heroic assumptions about how these securities would behave. The most crucial assumption was that mortgage defaults in different parts of the country would be uncorrelated. That if housing prices fell in Florida, this wouldn't affect the likelihood of defaults in California. This assumption was not just wrong, it was catastrophically wrong. By 2006, the agencies had assigned AAA ratings to 93% of mortgage-backed collateralized debt obligations, known as CDOs, despite their obvious risks. When housing prices began falling nationwide, defaults became highly correlated, and securities that had been rated AAA suddenly became worthless. In 2007, as the housing market faltered, Moody's downgraded 83% of the $869 billion in mortgage securities it had rated AAA just the year before. Such a violent reversal was unprecedented, revealing that the agencies had failed to account for obvious risks and had seriously underestimated the systemic dangers of their own ratings. When the music stopped, some of the most venerable financial institutions in the world were caught in compromising positions. Each had its own story of dubious decisions and, in some cases, outright deception. Lehman Brothers became the poster child for Wall Street excess, but its downfall was largely self-inflicted. The firm had aggressively expanded into commercial real estate, accumulating an $85 billion portfolio just as the market was peaking. More troubling, Lehman's executives routinely dismissed warnings from their own risk officers. The firm's culture of aggressive risk-taking, combined with its heavy reliance on short-term funding, made it a disaster waiting to happen. Goldman Sachs emerged from the crisis battered in reputation, but relatively intact financially. And this was no accident. Goldman had quietly hedged against the very mortgage securities it was selling to clients. The most notorious example was the Abacus deal, where Goldman created a synthetic CDO filled with mortgage securities specifically chosen by hedge fund manager John Paulson because he wanted to bet against them. Goldman sold this CDO to investors while failing to mention that the underlying securities had been handpicked by someone betting they would fail. When the securities collapsed, investors lost over $1 billion, while Paulson made $1 billion. Goldman's defense was that it was just facilitating a market transaction, but the episode revealed something troubling about Wall Street's relationship with its clients. American International Group, or AIG, wasn't even a bank, but it became the central domino that regulators feared would trigger total collapse. Through its London-based financial products unit, AIG had written an astonishing volume of credit default swaps on mortgage securities, essentially selling insurance on roughly $300 billion worth of subprime mortgage assets. For years, this seemed like free money. The swaps brought in steady premiums, and AIG's executives confidently believed that housing markets were fundamentally sound. But when mortgage bonds began failing, AIG's swap contracts became massive liabilities. Even worse, once AIG lost its AAA credit rating, it was required to post tens of billions in cash collateral to its counterparties. Cash the company simply didn't have. The government's decision to bail out AIG with $180 billion was controversial, but regulators believed they had no choice. AIG's failure would have triggered a cascade of losses at banks and pension funds around the world. The rescue effectively meant that taxpayers were bailing out AIG's counterparties, including Goldman Sachs, which ultimately collected $12.9 billion from the AIG rescue. While mortgages were being securitized and packaged into CDOs, another revolution was occurring in the derivatives market. Credit default swaps, originally designed as a form of insurance against bond defaults, had mutated into something far more dangerous. A speculative instrument that allowed investors to bet on the failure of assets they didn't even own. This created a situation where the notional value of insurance greatly exceeded the value of the underlying assets. It was like being able to buy fire insurance on your neighbor's house, or on every house in the city. By 2007, The credit default swap market had grown to $60 trillion, roughly the size of the entire global economy. The complexity was staggering. A typical CDO might contain slices of mortgages from dozens of different regions, all linked by the assumption that housing prices would continue to rise. When the housing market turned, these instruments didn't just lose value. They amplified the losses throughout the financial system. Even more dangerous were synthetic CDOs. CDOs composed entirely of credit default swaps that referenced other mortgage bonds. These allowed multiple insurance contracts to be written on the same underlying asset, magnifying the potential losses. As housing prices fell, these instruments spread contagion through the global financial system like a virus. The crisis revealed how thoroughly interconnected the global financial system had become. What started as a problem in the U.S. housing market quickly spread to banks and investors around the world. European banks, it turned out, had been just as active in the U.S. mortgage market as American banks. UBS in Switzerland wrote down over $50 billion in mortgage-related losses. Royal Bank of Scotland required a massive taxpayer bailout. Even German regional banks, supposedly conservative institutions, had gorged themselves on U.S. mortgage securities. The crisis spread through multiple channels. European banks had funded their U.S. investments through short-term borrowing in dollar markets. When those markets froze, it created a liquidity crisis that paralyzed the global financial system. Trade financing disappeared virtually overnight, causing global trade to collapse. Even countries that had minimal exposure to U.S. mortgages couldn't escape the fallout. In the fourth quarter of 2008, Asia's GDP, excluding China and India, plummeted by nearly 15%, a sharper contraction than the U.S. experienced. The crisis had become a global recession that would claim millions of jobs and trillions of dollars in lost output. The government's response revealed uncomfortable truths about power and privilege in the financial system. The Troubled Asset Relief Program provided $700 billion in emergency funding, while the Federal Reserve created lending facilities that ultimately provided over $1 trillion in liquidity. But the pattern of who got saved and who didn't revealed the arbitrary nature of crisis decision-making. Bear Stearns was rescued through a Fed-backed merger with J.P. Morgan Chase. Lehman Brothers was allowed to fail. AIG was bailed out with the largest rescue in financial history. Washington Mutual was seized and sold to J.P. Morgan at a fire sale price. The decisions often came down to ad hoc judgments made in the heat of panic, with little consistency or transparency. Treasury Secretary Paulson, a former Goldman Sachs CEO, claimed that legal constraints prevented a Lehman rescue, but many observers suspected that political considerations played a role. Most troubling was the lack of accountability that followed. Despite widespread evidence of reckless behavior and, in some cases, outright fraud, virtually no senior executives at major financial institutions faced criminal prosecution. The Justice Department's explanation was that these cases were too complex, and that the executives' actions, while reckless, didn't rise to the level of criminal intent. The message was clear: if you're big enough and connected enough, you can privatize gains and socialize losses. This too-big-to-fail problem hasn't gone away. It has gotten worse. The largest U.S. banks today are even bigger and more dominant than they were before the crisis. Today, more than 15 years after the crisis, many of the underlying problems remain unresolved. The financial system is still dominated by a handful of enormous institutions that are even more interconnected than before. New forms of systemic risk have emerged around climate change, cyber attacks, and technological disruption. The credit rating agencies still operate under the same issuer pays model that contributed to the crisis. Wall Street's compensation structures still reward short-term risk-taking over long-term stability. The derivatives market continues to grow, with new instruments that are even more complex than the CDOs and credit default swaps that caused so much trouble in 2008. Perhaps most troubling, the political will for meaningful reform has largely dissipated. The Dodd-Frank Act introduced some important safeguards, but many of its provisions have been weakened or rolled back. The 2018 Economic Growth, Regulatory Relief and Consumer Protection Act reduced oversight of mid-sized banks, contributing to the failures of Silicon Valley Bank and Signature Bank in 2023. These recent bank failures revealed that the fundamental vulnerabilities in the financial system remain. Silicon Valley Bank's collapse was triggered by a classic maturity mismatch. The bank had invested in long-term bonds while relying on short-term deposits. When interest rates rose, the bank faced massive losses and a depositor run. The government's response, guaranteeing all deposits, even those above insurance limits, was another bailout in all but name. Behind all the talk of CDOs and credit default swaps were real people whose lives were fundamentally altered by the crisis. The official unemployment rate reached 10%, but that doesn't capture the millions who lost homes, savings, or faith in the American dream. The crisis revealed a profound disconnect between the financial system and the real economy. While Wall Street executives collected billions in bonuses for creating increasingly complex instruments, ordinary Americans saw their retirement savings evaporate and their communities devastated by foreclosure. This disconnect fueled political movements that continue to shape our politics today. The Tea Party movement on the right and the Occupy Wall Street movement on the left both drew energy from anger about the bailouts and the perception that the system was rigged in favor of the wealthy and well-connected. The failure to hold anyone accountable for the crisis was particularly corrosive to public trust. Not a single top Wall Street CEO was prosecuted for their role in the events leading up to the crisis. The lack of consequences sent a clear message. The rules are different for the powerful. The 2008 financial crisis wasn't just a failure of regulation or risk management, it was a failure of understanding. We had created a financial system that was too complex for anyone to fully comprehend, too interconnected for anyone to control, and too important to allow to fail. The reforms that followed, higher capital requirements, stress tests, resolution procedures, addressed some problems, but not the fundamental ones. We treated the symptoms while ignoring the disease. The basic incentive structures that encouraged excessive risk-taking remain largely intact. More troubling, we've allowed the too-big-to-fail problem to get worse. The largest banks are now even bigger and more dominant than they were before the crisis. The derivatives market continues to grow, with new instruments that may be even more dangerous than the ones that caused the 2008 crisis. The recent troubles with regional banks in 2023 show that the risks haven't gone away. They've just migrated to different parts of the system. The government's response to these failures, guaranteeing deposits above insurance limits, shows that the too-big-to-fail doctrine now extends to institutions that aren't even that big. The untold story of 2008 is not just about what went wrong, but about what we still haven't learned. We've treated the crisis as a historical event rather than a warning about the nature of modern finance. We've focused on the specific triggers rather than the underlying dynamics that made the system so fragile. The crisis revealed that in finance, as in many complex systems, small changes can have enormous consequences. A relatively modest decline in housing prices triggered a global catastrophe because the system had become so leveraged and interconnected. The lesson isn't just that we need better regulation, but that we need to design systems that are inherently more stable. We need to recognize that complexity is not wisdom, and innovation is not always progress. The financial system exists to serve the real economy, not the other way around. The ultimate test of any financial system is not how much profit it generates or how sophisticated its instruments are, but how well it serves society's needs for stable, sustainable economic growth. The next crisis may not look like 2008. It may be triggered by climate change, cyber attacks, or geopolitical tensions. But whatever form it takes, we can be sure that it will exploit the same fundamental weaknesses in our financial system: excessive complexity, moral hazard, and the belief that we can engineer away risk through mathematical models and regulatory oversight. The men and women who sat in that Federal Reserve conference room in September 2008, watching Lehman Brothers die, thought they understood the system they were managing. They had sophisticated models, decades of experience, and access to vast amounts of data. But they were operating in a world that had become too complex for anyone to fully comprehend. That world hasn't become any simpler. If anything, it's become more complex, more interconnected, and more fragile. The question isn't whether we'll face another crisis, but whether we'll be wise enough to heed the warnings when they come. The story of 2008 is still being written. How it ends depends on the choices we make today. We can continue to add complexity to an already fragile system, or we can step back and ask fundamental questions about what we really need from our financial system and how we can make it more stable and more just. The clock is ticking. The next crisis may be closer than we think. And when it comes, we'll discover once again that the most dangerous moment in finance is when everyone believes they have everything under control. Thanks for watching. If you found this video useful, don't forget to like, share, and subscribe to the Capital Compass, so you won't miss any future deep dives into the forces shaping our world. See you in the next video.